Welcome back to Iron Financial, the one place where we help you forge a stronger, more resilient portfolio by cutting right through the market's weakness. Today, we are putting a true $50 billion behemoth, MetLife, ticker MET, right under our microscope. Their big earnings report is set to drop on February 4th, and you know what that means. We're running our full, no-holds-barred pre-earnings stress test. Now, the question we're asking today is actually pretty simple. Is this company built on a foundation of solid steel, or are we looking at a crumbling concrete facade? You know, the market, it seems to think it already knows the answer, so our job is to dig in and find out for ourselves. Let's get to it. Okay, look at this. This chart lays out the core conflict, the central problem, in no uncertain terms. Over the last year, the S&P 500, the broad market, climbed a really solid 17%. Not bad. The financial sector itself, which you can see here with the XLF ETF, it rose over 15%. So the whole neighborhood is doing pretty well. And then you have MetLife. It's actually down almost 5%. That's not just lagging, that's a performance gap of over 20 percentage points against its own sector peers. So you have this titan of the insurance world, a household name, just getting left in the dust, while everyone else in its category is rallying hard. The market is basically screaming from the rooftops that there is a serious problem here. Our job, our entire mission today, is to figure out if the market is right or if it's missing a massive opportunity that's hiding in plain sight. So, here's how we're going to tackle this. This is the blueprint for today's stress test. First, we start with that big question. Is MetLife a fortress or is it just a facade? Then, we're going to crack open their official GAAP results, the numbers they report to the world. After that, we do what we do best here. We forge our own adjusted numbers to find the real core operational engine. And once we have that, we inspect the individual business pillars to see what's actually doing the heavy lifting inside the company. Then, and only after we've done all that work, do we deliver the final iron financial verdict. All right, enough talk. Let's get to work. First things first, we have to look at the official story. Before we can find the real structural integrity of any company, we absolutely have to examine its public face. And in the world of finance, that means starting with their GAAP numbers. That's generally accepted accounting principles. This is the version of reality they are legally required to report to the public. And for us, it's always our starting point. You know, it's the story they're telling the world. Let's see just how convincing that story really is. And right away, this is where the market gets nervous. Just look at the top line, the total revenues. They're actually pretty stable, hovering right between $17 and $18.5 billion every single quarter. That suggests a pretty steady, predictable business, right? But now, cast your eyes down to that bottom line, the net income. It is all over the map. I mean, it plunges from over $1.2 billion down to under $700 million, then just kind of creeps back up a little. The top line is steady as a rock, but the bottom line, it looks like an EKG during a heart attack. This is the official picture. And let's be honest, it looks choppy, it looks unstable, and frankly, it looks weak. This is precisely the kind of noise that spooks investors and makes them hit the sell button. Right. So if this is the story the company is telling everyone, it's a really confusing one. It doesn't inspire a single shred of confidence. When you see this kind of wild volatility in the bottom line, you can't help but wonder if management even has a firm handle on the business. It just looks chaotic. So the absolute crucial question for any serious analyst, for anyone watching this, is this. How in the world do we find the real operational signal that's buried deep under all of this accounting noise? Simple. We forge our own. This is where the real work begins here at Iron Financial. Our job is to take the raw, noisy, and confusing data the company gives us and forge it into something that is clear, strong, and actually useful for making decisions. And we do that by calculating something called adjusted earnings, where we systematically strip away all the volatile, non-operational items to get a true, unvarnished look at the health of the core business engine itself. Okay, let's be really precise about what this is. Adjusted earnings is a non-GAAP metric. This means it is not the official accounting number. For a massive insurance giant like MetLife, their official GAAP results get heavily distorted by the performance of their gigantic investment portfolio. They have billions invested in the market. So any swings in the stock or bond markets create huge paper gains or losses on their investments and their derivatives. So, wait a minute. Are you saying that those huge swings in net income we just saw might have very little or even nothing to do with how well they're actually running their day-to-day insurance business? It's just market noise? Precisely. It's just the tail of the investment portfolio wagging the dog. So what do? We strip that out to see the real engine underneath. Let's put this whole process into action right now, using the third quarter of 2025 as our test case. So we start with that official GAAP net income number. $818 million. Then we go hunting for the market noise. And in this quarter, the single biggest offender was a net derivative loss of $929 million. Now, it's critical to understand, this is a non-cash mark-to-market accounting adjustment, right? It's not a real operational loss. Nobody wrote a check for that amount. It's just an accounting entry that reflects a temporary change in the value of their complex derivatives portfolio.
Exactly. So you remove that, along with a few other similar items, and what you're left with is the stable operational core. And just like that $818 million profit, it transforms into a much more powerful 1.584 times billion dollars in core operational adjusted earnings. It's a night and day difference.
And listen, this isn't some kind of one-time accounting trick. Just look at the two stories side by side for the last 2 quarters. The Gap story, that public facade, it shows a company that looks like it's struggling, with profits of just under $700 million in Q2, limping up to a meager $818 million in Q3. It looks weak and stagnant. But the adjusted reality, the number we forged, it tells a completely different tale. It shows a powerful and importantly a growing core, moving from over $1.36 billion in Q2 all the way up to nearly $1.6 billion in Q3. This isn't a company that's struggling at its core. This is a company with a powerful, humming operational engine that is being completely obscured by the fog of market volatility. This right here, this is the source of that massive disconnect we saw in the performance chart at the very beginning. The market is reading the wrong story. Okay, so we've now established that the company's foundation is far stronger than it appears on the surface. We have the solid base of nearly $1.6 billion in quarterly adjusted earnings to build on. So the next phase of our stress test is to deconstruct the machine, right? We have to look at the individual business pillars that are resting on top of this foundation to see which ones are actually carrying the load, and more importantly, which ones might be showing some signs of weakness. This chart is great because it shows us exactly where that power is coming from. In the third quarter, that profit engine was actually surprisingly well balanced between 3 main pillars. You see, the Asia segment was the largest single contributor at 34%, but the 2 big U.S. pillars, that's Group Benefits and Retirement and Income Solutions, or RIS, they were right behind it, pulling their weight at 29% and 28% respectively. And then you have Latin America chipping in a very respectable 9%. Okay, so it's not a one-trick pony, that's good to see, but the key takeaway for me is that the Asia segment is still the primary engine. It's doing a disproportionate amount of the heavy lifting here. A powerhouse, there is no doubt about it. $540 million in a single quarter from just one geographic segment is incredibly impressive, but is it stable? Whenever you see a structure leaning this heavily on one single support pillar, you absolutely have to start asking about concentration risk. The entire bull case for MetLife really seems to hinge on continued strength and growth coming out of Asia. So, what happens if that region hits an economic speed bump? What happens with currency fluctuations if the dollar gets stronger? It's the right question to ask. Is the rest of the business, are the other pillars strong enough to pick up the slack? Or would the whole thing start to wobble if Asia slows down?
And to answer a question like that, we have to look beyond the quarterly profits and examine the very bedrock of the entire company, the balance sheet. This tells us about the overall financial health and, critically, its resilience. And what we see here is nothing but reinforcement. Just look at the 9 months from the end of 2024 to the end of September 2025. Total assets have swelled from $677 billion to almost $720 billion. But the most crucial line item here, the one you really need to focus on, is total equity. Yeah, that's the net worth of the company, what's left over after all the debts are paid. And it's grown by $1.5 billion in just 9 months. So what that tells you is that even with a potential weakness or slowdown in one segment, the overall foundation of the company is getting thicker and stronger every quarter. It can absolutely weather a storm. Okay, so the foundation seems solid, even with that reliance on the Asia pillar. This brings us to the pressure points. These are the critical questions that management absolutely needs to answer clearly on that February 4th earnings call. Question 1. Give us a clear, no-nonsense outlook for Asia. We want growth prospects and we want to know how you're managing currency risk. No fluff. And number 2, what specific actions are you taking to strengthen those core U.S. businesses? We need to see those pillars, Group Benefits and RIS, get stronger on their own. And finally, with a balance sheet this solid and with equity piling up on the books, what are the concrete plans for returning that capital to shareholders? We're talking buybacks, we're talking dividends. Investors have been patient through this underperformance. It is time for a payoff. All right, that brings us to the final judgment, the moment of truth. We've examined the public facade and we found it to be misleading. We've forged the true numbers and we found a strong, healthy core. We've inspected the individual pillars and we've tested the foundation. Now it is time to synthesize all of this data and deliver the iron financial verdict. Is this an undervalued opportunity that's built on solid steel, or is this a value trap with hidden fractures that the market is right to be worried about? Let's break it down point by point. Starting with the steel beams, this is the bull case, and it is compelling. Beneath all that surface noise, you have stable and, more importantly, you have growing adjusted earnings. That's huge. The balance sheet is an absolute fortress, with total equity consistently increasing. Wall Street analyst consensus is a solid moderate buy, and the potential for a significant return of capital to shareholders is very, very real. But you absolutely cannot ignore the stress fractures. The bear case here is rooted in reality. That significant stock underperformance is a fact, not an opinion. It's painful for anyone holding the stock. The heavy reliance on a single geographic region, Asia, for a third of the profits is a legitimate concentration risk. And let's be totally honest, the official GAAP results are undeniably volatile and confusing to the average investor, and that confusion will always keep a lid on the price. Plus, there are still unanswered questions about the strength and dynamism of their core U.S. businesses. But when you weigh the steel beams against those stress fractures, Wall Street has clearly made its bed. The average price target from the 19 analysts who cover this stock day in and day out is $93.50. From where the stock is trading right now, that represents a potential upside of more than 17%. So what that's telling you is that the professional consensus believes the strength of those steel beams more than outweighs the risk of the stress fractures. They believe the market is fundamentally mispricing this stock and that a correction to the upside is coming. So, there you have it. The stress test is complete. All the evidence is on the table. You have a company that looks weak and volatile on the surface, but appears to be incredibly strong and stable at its core. You have significant, frustrating underperformance, but you also have significant potential upside, at least according to the pros. With the earnings report and, just as important, management's commentary coming on February 4th, the company has its chance to tell the market the real story, the adjusted story. The ultimate question for you, the investor, is this. Will MetLife finally prove that its foundation is made of solid steel and begin to close that massive performance gap? Or will the cracks that the market fears finally start to show? The answer is just around a corner.